Have you ever watched your investments plummet in value, your heart pounding with fear? Market volatility can feel like a roller coaster ride, sending emotions on a dizzying spiral. But what if you could face those ups and downs with unwavering calm? What if you could turn market chaos into an opportunity for financial growth? Mastering your emotions is the key to achieving true financial freedom. It's not just about picking the right stocks or timing the market perfectly. It's about understanding how your mind reacts to the inevitable fluctuations of the market. By harnessing the power of investor psychology, you can make rational decisions and stay on track to reach your financial goals. Market volatility simply means the degree to which investment prices fluctuate. It's the roller coaster ride of the financial world, where prices can soar to dizzying heights or plummet to unexpected lows within short periods. Imagine a quiet lake versus a raging river. The lake, with its serene and steady waters, represents a stable market where prices move predictably and changes are gradual. The lake represents a stable market, while the river symbolizes volatility. The river, with its unpredictable currents and sudden surges, mirrors a volatile market where prices can change rapidly and unpredictably. Remember the sudden stock market crash of 2020 triggered by the global pandemic? That's volatility in action. It was a stark reminder of how quickly market conditions can change, impacting investments and economies worldwide. It can be unsettling, but understanding its nature is the first step to navigating it effectively. Investors often feel a mix of fear and excitement during volatile times, as the potential for both loss and gain is heightened. Volatility is a natural part of the market cycle. Just as seasons change, markets go through periods of calm and turbulence. Recognizing this cyclical nature helps investors stay grounded during the ups and downs. It's driven by factors like economic news, political events, and even investor sentiment itself. A single headline can send shockwaves through the market, causing prices to swing wildly. While it can be unnerving, it also creates opportunities. Savvy investors know that volatility can present moments to buy undervalued assets or sell overvalued ones, capitalizing on the market's movements. Just as a river carves its path, market fluctuations can create buying opportunities for savvy investors. By staying informed and prepared, investors can navigate the bumpy road to riches with confidence and strategy. Our emotions can be our worst enemies when it comes to investing. They can cloud our judgment and lead us to make decisions that are not in our best interest. It's crucial to recognize and manage these emotions to avoid costly mistakes. Fear, the most powerful emotion, can lead to panic selling at the worst possible time. When markets are volatile, fear can grip even the most seasoned investors, causing them to sell off assets in a rush, often at a loss. This reaction can exacerbate market downturns and lead to significant financial setbacks. Greed, on the other hand, can entice us into chasing risky investments with the hope of quick riches. The allure of high returns can make us overlook the inherent risks involved. This often leads to investing in overhyped stocks or speculative ventures without proper due diligence. Remember the dot-com bubble of the late 1990s. It serves as a stark reminder of what can happen when greed takes over. Investors were driven by the fear of missing out on the next big thing, leading to irrational exuberance. Fueled by speculative frenzy, investors poured money into internet companies, many of which had no solid business plans. The promise of astronomical returns blinded them to the lack of fundamentals. This speculative bubble grew rapidly, with stock prices soaring to unsustainable levels. When the bubble burst, countless investors faced devastating losses. The market correction was swift and brutal, wiping out billions of dollars in market value. Many who had invested heavily in these speculative stocks saw their portfolios decimated. Another common trap is herd mentality, the tendency to follow the crowd blindly. This behavior is often driven by the belief that if everyone else is doing it, it must be the right thing to do. However, this can lead to poor investment choices and significant losses. When everyone is buying a particular stock, it's tempting to jump on the bandwagon without doing your own research. This can result in buying at inflated prices and suffering losses when the market corrects. But remember, the crowd isn't always right. It's essential to conduct your own analysis and make informed decisions based on sound research and a clear understanding of your investment goals. By doing so, you can avoid the pitfalls of fear, greed, and herd mentality, and build a more resilient investment strategy. So, how do you stay calm amidst the storm? In the fast-paced world of investing, it's easy to get swept up in the chaos, but maintaining your composure is crucial for long-term success. The answer lies in cultivating emotional balance and adopting practical strategies. Emotional balance helps you stay grounded, while practical strategies provide a clear path forward. Mindfulness techniques like deep breathing and meditation can help you become more aware of your emotions and avoid impulsive reactions. These practices train your mind to stay calm and focused, even when the market is volatile. Define your financial goals and create a plan to achieve them. Knowing what you want to achieve financially gives you a sense of direction and purpose. Having a clear roadmap will keep you focused and prevent you from making rash decisions based on short-term market movements. A well-thought-out plan acts as your guide, helping you navigate through market ups and downs. Don't put all your eggs in one basket. Diversification is a key strategy to manage risk. Diversifying your portfolio across different asset classes can help mitigate losses and smooth out the ride. By spreading your investments, you reduce the impact of any single asset's poor performance on your overall portfolio. Legendary investor Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This quote perfectly encapsulates the importance of emotional discipline in investing. When others are panicking, that's often the best time to buy our undervalued assets. Financial expert Dave Ramsey advises, investing is not a get-rich-quick scheme. It's about building wealth gradually over time. Patience and consistency are crucial for long-term success. You've all experienced the emotional roller coaster of market volatility. Sharing your experiences can be incredibly therapeutic and empowering. It helps you realize you're not alone in this journey. Have you ever made an impulsive investment decision based on fear or greed? What did you learn from that experience? How do you manage your emotions during times of market turbulence? Share your story in the comments below. Remember, mastering investor psychology is an ongoing process. It requires self-awareness, discipline, and a willingness to learn from your mistakes. By adopting the strategies outlined in this video, you can navigate market volatility with confidence and stay on the path to financial freedom. End your journey to financial freedom by subscribing to our channel and visiting our website for more resources.